As part of your financial statement audit, you may be told that you have to have a valuation done of stock options or similar equity compensation that's been granted over the last reporting period. Your audit firm is not allowed to perform the valuation themselves because they would in effect be auditing their own work, and so it becomes an independence issue. In addition, you as a client are typically strongly discouraged from doing the evaluation yourself for the same reasons. The overwhelming majority of the time, you will be asked to retain a third-party valuation firm, such as High Score Strategies. The valuation process will involve performing a valuation of the company itself, as well as the equity instruments that were granted. This valuation is typically performed using market-based approaches, such as the merged and acquired company method or guideline public company method. If your company has raised money recently, you may be able to use what's called the backsolve method, in which you effectively rely upon the valuation indicated by the most recent financing round as the starting point for the overall company valuation. The backsolve method involves starting with a financial forecast, building a discounted cash flow model, and reverse engineering the valuation itself to have the discounted cash flow model fit that valuation. The second step will be to perform an allocation of value within the capital structure. Now, if your company simply has common shares and straightforward garden variety plain vanilla debt, then this will generally not pose much of a problem. You can simply figure out the value of the company, subtract the debt, divide by the number of shares, and then apply an option pricing model to determine the value of the instruments, and off you go. However, if you're a company that has a complex capital structure, such as a venture-backed technology company, there's a very good chance that you have multiple classes of stock. Often they're called preferred shares. And these preferred shares have features that give the holders of those shares preferential treatment, such as convertibility into common stock, such as a liquidation preference, meaning that in the event of a liquidation or a liquidity event, the preferred shareholders are paid first, or a preferred or guaranteed dividend, or other features as detailed in the shareholder documents. The task of the valuation analyst in this case is to capture the appropriate value features of the preferred shares and then assign the remaining value to the common shares. And this is important because most of the time, equity compensation is tied to some sort of common shares. Once the value of the common stock has been determined, then the valuation analyst can proceed to valuing the actual value of the instruments themselves. This is typically accomplished using an option pricing model, such as the Black-Scholes option pricing model, which has been around since the 1970s. The model isn't perfect, but it is generally considered the gold standard for option pricing in the financial reporting area. Finally, the valuation analyst may decide to apply discounts, such as discounts for lack of marketability and control. After this has been accomplished, the fair value of the equity compensation has been achieved, and the financial statement auditor will know what expense to put on the company's income statement for the financial reporting period. It's important to get this right because one of the most frequent reasons for a financial restatement to be required, which is generally a painful exercise for everybody involved, is because of some material flaw in the determination of the fair value of the instruments. Now, at a micro level, it's also important to get this right and to work with a provider who knows what they're doing, because the auditor's job is to, in effect, audit that valuation, which means they must be convinced that that valuation is sufficiently credible and reliable that it can serve as the basis for supporting your financial statements. And the auditor has the final say as to whether or not they will accept that valuation or not. And there are cases where I've seen cases where auditors have, in fact, simply rejected a valuation if they can't work with the valuation analyst to produce a result that they find sufficiently reliable for the audit work file. But by getting this right, working with an experienced provider, you will avoid a lot of back and forth, avoid a lot of questions, avoid a lot of conflict. You'll avoid a lot of excess cost within the audit process, and generally speaking, make your life a lot easier. So these engagements have been the most successful. I've been in close contact with the auditor to make sure that the auditor and I and the client are aligned in terms of what the basic fact pattern is around the company, to understand what the fact pattern is around the capital structure, the actual equity instruments that have been issued, as well as to achieve agreement on, generally speaking, on the procedures that are going to be used and the data that will be used to support those procedures, so that when the auditor does finally receive my work product, they're not going to be surprised. In effect, I've gotten the answers to the test beforehand. So if you've been informed that you need to have a valuation done of stock options or other equity compensation that you've granted in the last reporting period, give us a call. We can help make sure that your audit process goes while minimizing the expense of your compliance process and let you focus on the things that you want to get back to doing.